So I would like to welcome everybody to our quarter one presentation. I have a lot of good news and a couple of bad news today, and I try to update you on the reality of Protector. I understand that the stock price went down a little bit this morning, so my ambition is to explain the reality in such a way that the share price either stabilizes or are turning the right way, So if I go to the highlights of the quarter, I think there are two or three important things when it comes to the highlights. One is a very strong growth, size 26, which is in line with our expectations or slightly higher. As earlier communicated, it is Sweden and Denmark driving the growth of Protector at the moment. We also have a headline here: the first UK customer is signed, which is a milestone in the company history. And I will, of course, update you more on UK later in the presentation. The result as such is rather poor. So the results before and after tax is what we would call poor in Protector. The question is, what about the underlying reality? Is the reality poor? Is it average? Is it good, or is it better than good? So I tried to explain more. But there are two indications on the foil here. You see that the underlying reality is very good, actually. One is that the underlying profitability is close to last year, quarter one, which was very good. So the underlying combined ratio is closer to 81, which was 82 last year. There are two one-off effects attacking Protector in quarter one negative and one positive. And I explain more, but in my opinion, these two are one-offs, one positive, one negative, and they will not be seen in the quarters to come. So if you are looking through the figures and see what's really is happening, we have also a good start in underwriting areas in Protector. Whether you trust that message or not, it's up to you to decide. So give me 55 minutes and see where we end in that area. The subordinated loan is placed successfully. You're aware of that fact. It is giving Protector a lot of financial capacity to continue growth, both in Scandinavia and in UK. So if you are looking on our solvency ratios today, they are comparable with Gjensidige. And I think you might think they are a pretty strong company, and we think Protector also is a pretty strong company. So if I go to the next slide, it's the premium. What you can see on the slide here is that Sweden and Denmark is driving growth, as expected. They are a bit on the higher end, so they are a bit better than expected, actually. So I'm very satisfied with the growth. And the question is whether it's possible to grow with 50 or 60 percentage points in local currency and at the still have a good control on your underwriting and your profitability, because that's difficult in the insurance sector. And you will see a slide or two later on, which at least indicates that the profitability in Sweden and Denmark is very good at the moment, actually. And I continue then to explain a bit more the underlying reality in Sweden and Denmark. Sweden and Denmark is driving volume, which is very good. It's a tougher market in Norway, so we are down on volume, which is in line with expectation, and the real estate market is slowing down a little bit, so the turnover is not as high as in the earlier years, so we're losing some volume, which is market-driven. That's okay. Okay, the very big negative figure in the presentation is the claims ratio. So as you can see, the claims ratio is on a high level. So the question is whether this is an underlying reality or whether this is a one-off type of situation. And my communication to the market is that this is a one-off situation. It's linked to change of ownership only. It doesn't mean that change of ownership during the last 5 years is unprofitable. It's still an acceptably profitable product the last 5 years. And the question now is, what kind of actions should we take in order to get back in profits? Will that happen without any new actions, or is it necessary to take more actions? I'll be back on change of ownership area, which is the kind of negative surprise in the figures today. However, I have been rather open communicating to you earlier that you shouldn't expect the first half year to be good. And when picking up the subordinated loan, both in writing and verbally, I've given a warning that this is an issue where we have a lot of concentration at the moment, and we have still not fixed the things we can fix totally, and the figures is lagging behind, as always in the insurance sector. From getting focus on a problem in the insurance sector, as many of you know, it normally takes 12 to 24 months before you can fix it. The question is whether in such a product, whether it takes longer or shorter time. And you could argue it takes longer because it's a medium tail product, and actions you are taking will not have any effect on a very short run. It will not. But in my opinion, the main reason is the 86 million Norwegian kroner one-off loss in change of ownership area, which causes the problem. 85% of the volume of Protector is outside that segment. And everything outside is growing, while change of ownership is slowing down, or in this quarter, even losing volume. So the healthy part of Protector today, in the short term, is the 85% of the totality, while the 15% is unhealthy in quarter one, but not in long term unhealthy, in my opinion. So that's the good story. That's a rather strong story. And we have a question here. If you could please leave the microphone, Andreas.
Yes, this is Vega from Pareto. I was just wondering, since you're discussing the measures and you're also discussing the time it takes to fix this product. We saw a need for reserve strengthening last quarter, 65 million. And we've seen another reserve strengthening this quarter of 86 million. And you're commenting also that the next quarter will be below the longer-term expectancy. Should we expect a similar reserve strengthening also next quarter?
No. I would expect that, but as you know, on medium long-term tail type of products, it's hard to say. So my expectations is absolutely not in line with what we have seen in quarter one. I will be surprised if we see something close to it. But I would expect some reserve losses also in quarter two in change of ownership area. In a quarter which will be doubled in size in change of ownership, so potential quarter two losses will be divided on more volume and will not influence as much. So I expect that to be on a lower level, on a bigger volume, and that problem gradually disappears. My expectation for quarter three is a rather strong quarter, actually. So the seasonality effects and the way the actuarial model works in these areas is not very easy to predict, but it's possible to predict something. So yes, some reserve losses in quarter two, turning back again in quarter three. And as you have seen, the company guiding on combined ratio, the total guiding, is in line with previous guiding. So we haven't changed opinion, despite the fact that we have a reserve loss or a strengthening, which is the same thing, in quarter one in change of ownership. Okay, I explain more actions which have been taken and will be taken at a later stage related to this kind of quarter one problem area. Okay, cost development is going down extremely rapidly, in fact. I guess that nobody of you have really expected going from 7.5 to 6.1. The cost level, though, last quarter one was rather high. It didn't look very high, but we knew it was high. So the difference is not really 1.4. It was a weak cost quarter, last quarter one in 2015 actually. So this is a bit on the better end. You shouldn't expect 6.1 in any quarter, but we have guided on lower than 7.5 at the end of the year, and we are ahead of schedule on that. We are world leading on cost, as you know. I've never ever met anyone with a cost ratio even close to Protector. My neighbors south of Norway, Trygg, are giving a statement to the market that they do have world leadership on cost. They are, what, 14 or 15? We are 6. And as some of you know, even if we go into an apple-to-apple comparison, not only company to company, we are basically half the cost of competitors and even stronger in some markets. And it's obvious that the cost level in the UK is higher than in Scandinavia, apple to apple. So the cost advantage of the company is improving very quickly at the moment. And the position of Protector is even stronger, both in Scandinavia, but also attacking segments in the UK market. In the long run, this is the most important factor in Protector. And my prediction, my estimates for the next 3 years is that the difference between Protector and competitors will strengthen. So the distance between Protector and others, apple to apple, will increase. And it's happening now, as we speak, quarter one, 2016. This is not a future statement, it's today's statement. So after 16 and 17 and 18. In 18, UK kicks in with volume. Guess what's happening with the cost? Now we have a 10-person team in UK with a lot of cost, of course. Everything done in a P&L statement of the quarter. So actually you could argue 6.1 is a bit high because we are investing in UK at the moment, but not putting any of these investments on the balance sheet, as you know. So a very, very strong message on the cost ratio quarter one. Even a bit better than what I expected a year ago or something like that. Okay, Norway. Volume-wise, some problems in Norway. Oil and oil services industry is under pressure, as you know, in Norway. We are the market leader in that sector when it comes to insuring the people. So when 50,000 people is losing their jobs, 15,000 of those are insured in Protector, and the average insurance premium per employee is rather high. So we are losing tenths of millions of Norwegian kroner in volume in that area. And in the municipality sector, the competition is increasing, KLP is fighting back, and we are losing market share, which is acceptable because now the price level in certain areas in the municipality sector in Norway is unprofitable. So we have just to walk away. Let KLP lose money and walk in the market, back in the market again. So we are not really running away from the market. We are still close to being number one in the market. But the present price levels we have seen in Stavanger, for instance, a big municipality, previously Protector customer, now lost to others, including KLP, is on a price level which in our opinion is unprofitable. Then we have to walk away. So we are going for profitable growth, not growth only. So a lot of pressure in the market in Norway, but a very good margin. We are earning good money in Norway, exclusive of change of ownership area. So no problems with the profitability. The competitive position is stronger than ever. And the brokers and end customer are valuing the quality of the company on a very, very high level. 2 days ago, we got a new quality survey delivered. It's not available for formal communications. We are not able to push it out to the market. But the quality survey done by the Broker Association in Norway puts Protector by far on the quality top, even on a higher level than last year. And there are 7 areas where they investigate quality, and we are number 1 in 6 out of 7. it's close to be small upload. No, we are not asking for that. No. But this is what it's all about. Cost and quality leadership leads to profitable growth. There are no growth in Norway, but we have cost leadership. We are strengthening the quality leadership, so we are happy in this market. If I go to Sweden, you can see 50 to 60% growth, depending on whether you look into local currency, which you should, in Norwegian kroner, a bit higher, and you see a very profitable quarter. There are some smaller run-off gains. You could discuss whether it's one-off or not, some smaller inside the figures. So the underlying reality is not that good, but this is extremely good. So it's not that good. It's only very good. So what's happening in Sweden at the moment is fast, profitable growth. Looking into Finland, we have established it's not a volume market, it's not important, but we are a true Nordic player. We did get Helsinki as the first client January the 1st, and we have 11 clients on board today. Not all of them on board in quarter one, not figure-wise, but some of them in quarter one and some will arrive in quarter two. But no significant volumes. But we are a true Nordic player, and it helps in certain situations in Finland. Denmark is a kind of an area where you had some questions after 2015, because the combined ratio in Denmark 2015 was what? 107. That's right, 107. And that was in the higher end, wasn't it? And my communication to the market, you shouldn't really be afraid of that, because there are some issues which are in a small country at that time. You have to look through it. And this is today a very, very good figure. The underlying reality, though, is not that good. So we are a lot better than 100 on combined in Denmark today. The cost ratio is dropping extremely quickly in Denmark. And then I mean extremely quickly as we speak, with volume up 80 and cost up close to nothing. Let's say 15 or 20. So the scalability kicks in as expected, but a bit faster. But we have some kind of, still in a new country, some kind of underwriting and profitability issues to fix. So even if the figures are very good, the underlying reality is only good in Denmark. But good is not bad. So good is good. So let's agree it's good. But it's not very good. It looks very good, it's not very good. So you got that now? Yeah, you did. So even my brother is in the room today. He is, hello brother. So he is 10 years later than me. It doesn't look like he's 10 years younger, of course. But so he is 10 years slower as well, but even he understood that good is good. So first time, he's a shareholder in Protector, of course. So he is borrowing everything he can on his house and his wife in order to invest in Protector. So far it has been a good journey, hasn't it, Thomas? So it's good that I had the opportunity to introduce you then. Okay, so Denmark is doing well, but we have to work on an accumulated basis. Sweden and Denmark is very good. And where is the growth coming from? From Sweden and Denmark. Where will the growth come from the next 2, 4, 6 quarters? Sweden and Denmark, especially January 1st next year. So the growth area today is Sweden and Denmark. We are growing rapidly, and we have an improving combined ratio, which accumulated was around 95 last year, which will go down based on at least what kind of expectations we have in 2016 at the end of the year. But there are small countries still, even if the size is comparable with Norway. So each country is only half the size of commercial sector Norway. There will be volatility. And this time, a bit of good luck, and a bit of volatility the right way. But it will turn, but not in a long run. Then we think that we are demonstrating that the model works in Scandinavia, not only in Norway. Okay, so then we are on the kind of the area which we have problems with the results. And I've talked about it, and the reserve losses. What happened? So we have to try to understand what happened. Is it only market-driven, or can we do something? And the response is this is partly something we can do and fix. So what happened is that the problem started in 2014, and we saw it too late. As you very often do in insurance business, when problems are arriving, they could be hard to see. And this is a rather complex area. It's possibly more difficult to see, but I'm not satisfied with my own kind of understanding. I should have seen it before. So it's not a good, I'm not proud of seeing it too late. But I saw it, and we saw it a bit too late. We had some management changes, maternity leave, role changes. We lost too many experienced people at the same time, and we started to lag behind on bigger claims. And lagging behind means two things. Conflict level is going up. It costs more. Secondly, reserves can improve because you are late to update reserves because it's not happening what it should happen in the claims handling process. So it's not kind of a decision taken by an individual person, but when lagging behind, reserves are shown to be better than reality. The CFO and we did see that. We saw that. So we added more reserves, but we added too little at that time. So we added more because we saw that the actuarial models didn't catch the reality. That happens in insurance every day. So it's normal. There's nothing wrong with the actuaries. There's nothing wrong with the claims handling people. It's the way it is. But you have to have experienced management in order to try to understand what's happening. So we put more reserves in the books. It was too little. I'm sorry about that. It was a difficult judgment. We could have, and today we should have. And then when you start to fix the problem, management capacity is back on track, recruitment of new capacity, gradually building more competence, it takes time. It's not just getting a person from the university, start working, and are competent. They are not competent after 2 days. It takes some time. We increased technical survey capacity, very important, up from 2 to 4. And we started kind of what we call a clean desk project. And open claims are down with 15% in Q1 2016. It works. But when it works, when you speed up, the reserves are turning all the way around. So now we have eaten the kind of management extraordinary reserves based on lagging. They have disappeared. And at the same time, it has kicked in more reserve strengthening in this quarter, which may be also some millions or some tens of millions, but not expected on the same level in Q2. So that's what's happening. The long-term question is what happens when you are up to speed in all the difficult claims areas. And I'm satisfied with the quality. And we have very strict kind of quality objectives in these areas. So we are not today lagging towards customers. We are basically clean desk today. But it has financial consequences. What will really happen in Q3, Q4, and in 2017 is a bit early to say. It could come back. It could stabilize. So my expectation is that this will stabilize in future on a profitable level without price increases. But we will consider price increases in Q3. It's too early to do today. We will consider. If necessary, we will kick them up I don't think it will be necessary, but if, we will kick them up. Kicking up now is too early. It will end up in losing significant market share in a future business which is profitable. That's not a good decision to take. It could look good, but it's not good. So we do things which is good, and at the end of the day, they will look good. They will. So my internal ambition is that we will have better than ever operational quality on claims handling in Q4, better than ever. And we have been rather good for many, many years. We are challenged by that, by some magazines, Achiever Channel now and then, as you know. But we know that the quality level is very good, and we can document that. That the quality level is good, and we will be on a historically high. And even some people in Protector, they decided yesterday morning to sign kind of a document to say that we will do over part of this. So we understand that you have an issue to discuss with the investors today, or tomorrow actually. But we are behind that statement, Sverre. And they decided themselves to sign off a small letter and say, we will be better than ever. And we would like to invite ourselves into your board meeting in December 2016 if we are not better than ever. So that's a good statement. And it's a part of the culture of Protector. People taking their part of the responsibility for fixing what we could fix in that area. So culture-wise, I'm proud of what happened. It was not an idea coming up from management. It was an idea coming up from one of the employees working in these kind of areas. So we will be back on track and earn money, but Q2 will be not good or poor or something like that, but not on the level we have seen in Q1. Okay, so what about UK then? We have prepared for 2 years. We have been analyzing how to underwrite a risk in the public sector for a year. We have been communicating with all 5 big broker houses a number of times. We have bought databases. We have given quotations to the market test quotations, and asked for feedback. And now we are live. And there is a very, very important day for Protector to have the first client on board, April the 1st, 2016. That's client number 1. And there will be, there will be more, but only slowly. Only slowly. It takes time, and we are not in a rush in order to boost volumes in the UK. However, we have already started to open up the dialogue in commercial sector, which is half a year earlier than expected. So I will meet commercial sector brokers in Manchester Tuesday and Wednesday, together with local management. This is ahead of schedule. So what we are seeing is a competitive environment which should be possible to maneuver in. And remember, we are a commercial sector company. We are more than twice the size in commercial sector compared with public sector. Very soon, 3 times the size of public sector. So even if entry point in UK is public sector, the end game is not about public sector. It's about being bigger in certain commercial segments in UK, but then segment-wise, not head-on, of course, not possible in that area. So we are on schedule. We have the first client on board. I think I gave that statement to you 5 months ago, something like that. We could have had 2. So if we had known what we know today, we would have had 2, because we are learning how to write a proposal or quotation based on public procurement rules in UK. So we are learning, and it looks good. It does. We will invite to a capital market day in late August. We had one in June last year. we will invite in August, and we will at least cover 3 areas. Sweden, because we didn't in last meeting. The country manager was ill, and we said we take that next time. So we will cover Sweden. It was also the first country we entered outside Norway, so it has a lot of relevance. So we will cover Sweden, we will cover UK, and we will cover investments in that capital market day. So you will be invited, of course, and hope you can join, and I think it will be end August. So we will be back talking a lot about UK, and also bring both the kind of project lead, Henrik Høie, the director in charge of setting up Protector in UK, together with myself and a team of other people. And you will meet Maureen, which is head of our operation in Manchester. So they will be there in a capital market day. Okay, so this is the UK. Do we have cultural challenges? No, we have cultural opportunities. Okay, so we do not call it cultural challenges. I learned that from a meeting with Handelsbanken in UK. And as you probably saw a couple of weeks ago, when Handelsbanken announced their results, you could see that the UK market was what? The other Thomas, sitting beside Thomas, the most profitable market in Handelsbanken, with a return on capital sized 15, while the Nordic countries had a return 14, 13, 12, and around that. So Handelsbanken have succeeded in the retail banking market in the UK, and it is the most profitable area. So the question is whether I think this will be our most profitable area in future. It may be. It may be. But it's a long journey to go. So we will, if you are here 5 years from now, we will know. Because that's realistic to see, because we will have critical mass faster in UK than Sweden and Denmark. So we can see these kind of situations 5 years from now. It's early to say. So it's not kind of a guiding or a promise or anything. But today, we can see that the cost ratio in UK is higher than Scandinavia. Quality level, we know more about quality level today. It's equally poor, Scandinavia. We call quality level Scandinavia poor because we are sky high compared with competitors. So it's equally poor or worse in UK. That's our opinion at the moment, which makes sense. The higher cost ratio, the poorer quality. That's normal. That's insurance business. So I'm rather optimistic about UK, but it will take time. So in significant volumes this year, a bit more than insignificant next year. What does it mean? I will not be more precise, but then it starts to kick in during 17, and in 18 it will be a big segment in Protector, for sure. We are constantly working on improving what we are doing. We are challenging not only the market, but we are challenging ourselves. We have another Route 66 project started, and we are ahead of schedule compared with last year. So we have another 66 projects. Around 40 of them did exist last year and have been reborn with new objectives in 2016. So continuity on improvements is important, but there are fresh new things on the agenda as well. And here is the kind of very short description on the 6 most important projects. This is UK, this is claims handling, this is claims handling, this is change of ownership, this is IT and business innovation, and this is underwriting, this is financial underwriting. So we have introduced a new word, or a new 2-word combination, which we haven't heard before. That is financial underwriting. So underwriting is an insurance phrase. Investments is not an insurance phrase. So we are trying to combine. And come back in August and have a look. And then we will update you on what we will call our way of investing money when insourcing. It's nothing very strange. It's not dramatic, not at all. So it's a set of minor elements in order to try to improve how to invest better, to less cost of capital, and to control risk, of course, in that area. So this is a teaser called financial underwriting, and have a look in August and see whether you like it or not. It's not very different from what you are doing, but it is different, but not very different from what you are doing. It's slightly different. It's more documented, I think. So I think that most of you are investors, so you start to think that I know everything, and we are better than you anyway, so I can't learn anything. But okay, have a look then in August. So let's have a look and see. Okay, the results are combined ratio sized 88. We are close to 2 billion Norwegian kroner annual premium today, up from 1.5. So the 26% growth is in the biggest quarter. So it's important to grow in quarter one, because it's by far the biggest quarter we have, because the renewal season in Scandinavia is January 1st, which is not January 1st in UK, which is good. It's April the 1st. So next April will be very interesting. 2016, no, sorry, 17. Very, very interesting. So it's good that everything is not focusing on January 1st volume-wise. So 1.9 up from 1.5, the biggest quarter in Protector, the big seasonality difference, as you know, and a combined size 88, and a one-off profit sharing sized 33 million, which will not be repeated in the quarters to come, which is linked to reinsurance contracts. And there are in property area. And everything is linked to the underwriting year 2014. So we are rather conservative when booking reinsurance income. So we normally book the minimum commission. So we have no downside, only upsides. And at the end of the year, we will consider, and the next year, we will maybe release some kind of reserves if there are profits to come out from the contracts. So there is a one-way situation. They are either positive or zero. So there are no downside, it's only the upsides. Is it anything more to come? Yes, it is. But this is a correct way, in our opinion. Be a bit conservative, not eat too much too early, and see at the end of the year and a bit later whether reserves are set correctly and whether it's coming in profit sharing on the reinsurance contracts or not. This is a traditional way of signing reinsurance contracts, so it's nothing special by the structure, but some companies are booking higher than minimum income every quarter. We are not doing that. And we haven't done for the last 3, 4, 5 years or something like that. No downside, only upsides. Will it be more? Yes. When? You have to wait and see in that area. But we consider this to be a one-off. So you could discuss whether it is or not. So we consider it to be a one-off. And adjusted for one-off, we are in line with last year, 82. Remember that there is a lot of commissions from reinsurance seasonality-wise. So we are not really that good. And the guiding is 90, as you know. So this is better because of this one-off, better than guided. But without that one, it would have been more in line with guiding. There is one element when you look deeper into the countings, is that we haven't booked any security reserves at all in the quarter, and we will not do for the rest of the year. Because we are over-reserved according to FSA requirements, and these kind of reserves will disappear. It will be a profit back in the books the day these kind of reserves are eliminated. There will be a tax effect probably on that one. So this is more on the technical side, but profit before and after security reserves will now be equal in 2016. We are over-reserved, it's not necessary anymore, and this kind of things is disappearing under the Solvency II regime, which is okay. It's not a problem in that area. But then you are updated on that kind of reality. It's not on this file here, or no, but it is in the interim report, which is passed to the market as well. Then you can see what I'm talking about. So the balance sheet is strong. The subordinated loan is placed, and the dividend will be paid, as you know. That has been announced, and will be out there Fleming a week from now or something like that. That was your question, brother, again. When will I have my dividend? Because I really need it. Okay, so but you knew, but I didn't. Okay, but that is a week from now, something like that. We are increasing the exposure in equities during the quarter, as earlier communicated, from 13.5 up till 18 point something, and at the same time reducing in high yield. The investment result is rather poor, but here is a very, very important element. After closing books, we have to update you on significant issues. This is a very, very significant issue. That is that investment portfolio has done extremely well the first 3.5 weeks in April. So given return size 3, and there is a 7 billion Norwegian kroner portfolio we are talking about, and that is more than 200 million Norwegian kroner results after end quarter. And we are ahead of schedule investment-wise, and the reason why is that our equities has done a lot better than market due to a couple of good investments. And some of you know the name of at least one of them, which is Norwegian Bank, which is a big share still in Protector. So we have a lot of shares in Norwegian Bank, and they have gone very well. But there are also a number of other which have done well. And the spreads in the fixed income portfolios has gone the right way. And that has, of course, influenced the return on investment in the fixed income area, including high yield US markets, where the spreads has gone down to a lower level in that area. So a very, very good investment start on quarter 2. And so if you normalize the investment income of the Protector, and if you normalize the underwriting results, you got the picture. So this is a pretty good kind of situation we have in Protector. Nothing new on shareholders issue. And here is a Solvency II update. We will be back with more information on the capital market day again after giving the first formal feedback to the FSA in end May, and have a discussion with the board on the new targets. Because the capital targets of Protector, they are history today, and we will communicate with FSA first and go to market later on, and give you an indication on what the future targets are when it comes to solvency, capital requirement ratios, dividend policy, and also the growth ambition of Protector for future. We have formally said 10 that will be considered together with the capital areas, of course, because capital and volume are linked together. So there will be information out there in the market, in the capital market day. So it will be a bit more than normal interest to follow Protector that day, I guess. In the meantime, we are very solid on solvency side. This is comparable with the Gjensidige based on the standard formula. And that is before subordinated loan, and after, you could argue, we are stronger than Gjensidige solvency-wise, based on standard formula. They have a partial internal model, as you know. They delivered extremely good results to the market yesterday. So it's a very, very strong figure from one of the Nordic market leaders, which is good because we are in a healthy market, the Nordic market. And the discipline in the market is still good, which is good. But solvency-wise, we are fine and will be better. And we have more than enough capital and strength in order to handle the volume to arrive in the next quarters and years. And we have a lot of space to ask for more subordinated capital at a later stage, if needed. The guiding 2016, given February 16, was 22 growth rate, 7.5 excuse me, cost rate, and combined 90. We are ahead of schedule on growth, not changing. We are ahead on cost, not changing. But my opinion is at the moment that we will have a good distance to 7.5 on the cost ratio then. That's what I'm saying at the moment. You will have good distance to 7.5. Could have changed, but it's not that important. It's not. And we are on schedule to 90, not because 88 is on schedule. That is slightly behind schedule, but because underlying reality is better than 88, which in my opinion means that we are on schedule in that area. So it's a maintained kind of guiding to the market. And then we are back on the summary again and the opening slide, which is the final slide. And my message is that the actual results in Q1 is poor. The growth is very strong. The underlying reality is good. And what has happened after Q1 is that investment result has turned back again. As always, that is volatile. And it has turned back, and we are ahead of schedule when it comes to investment income. And as you know, and we all know, that could change. But okay, we think we have a prudent investment philosophy. We are not risk seekers, but you should expect Protector to deliver slightly better than market, as always. Not every year, of course, in that area, like Marius and Katrine. Not every year, but in the longer run. Whether that is possible or not, I think you believe in it. That's the reason why you have invested in Protector. However, there are some studies showing that this is rather difficult in that area. It's not very important. The important thing for Protector is profitable technical growth the next 3 to 5 years. And we are doing very well, and we are fine. So thanks a lot for your patience when listening to my poor English, and thanks a lot to you joining us on webcast this time. So this is the first time, I guess, that I have to be on TV next time as well. I do not like it too much, but okay. Thanks a lot, and still have a good day.